Ramesh Damani joins us right now to talk about his thoughts. Ramesh, good morning. Thanks so much for joining in. Ramesh, as of now, we have cracks in the dam. Can the cracks widen up further? As a man who's seen many such cycles, many such convergences of global and local events, how are you approaching investing currently?
Good morning, Neeraj. Thank you for having me, first of all. Of course, it's a tough day to be on television giving your views out. But if you go back and search what happened over the last 3 years, say, you've had 3 or 4 occasions when the market has fallen in Sensex terms, 600 to about 1,000, 1,200, sometimes even 1,500 points. They happened on Demon Day, they happened on Brexit Day, they happened when the China crack-up happened in 2015. And the market has recovered from all those fairly nicely. So my first get-go to you was that this is a correction in a bull market. Corrections in bull market, for your viewers, always short, sharp, and swift. So they shake out, except the staunchest believers in that market, they shake them out, and then the market resumes its uptrend. It's just kind of a reminder that it's so hard to make money in the market that you have to remain committed long-term in order to truly enjoy the benefits of a bull market. So my first reaction was that the market did that. But then, of course, when you add the global potpourri of events of, possibility of rising interest rates out there, possibility of the Dow having topped off, that gives me some pause that maybe we'll have to weather this storm for a little bit longer. The good news, of course, Neeraj, is that the Indian economy is finally starting to do well. I think the third quarter results have been ahead of expectations of most analysts. There are green shoots of recovery well underway in the economy. A lot of sectors are doing well. So in terms of earnings, at least, I think there's reason to be more optimistic about the market.
How much of a dampener can this have to the overall scenario? I mean, Ramesh, what I mean is, until last week, the entire conversation, not just for India but across the world, was about how growth is looking up. Now this talk of yields in India, the added bogey of the budget and the long-term capital gains tax has come over to take at least center stage on the conversation table. How much of an overhang would that be to the overall earnings growth story that we're seeing, not just in India but across the world?
Neeraj, the two things that global markets haven't had to deal with in the last 3, 4, 5 years, or actually since the crisis, is inflation. I think we were most worried about deflation. I think the data of US payrolls suggests that inflation might be coming back in America. The data in India projects that because of the huge spend on rural India, the huge increase in MSP, that we will be fighting inflation in India in the next 6-8 months. Inflation could rise. In the short run, inflation is not necessarily bad for the stock market because it increases profitability. Costs don't rise as fast as prices rise at that point. So in the short run, it's okay. In the long run, of course, inflation is very detrimental to long-term equity values. So I think the first thing we will deal with is inflation, which wasn't dealt with in the past, which of course implies that interest rates whether in America or India are probably headed higher. In India, we've bottomed out on the interest rate cycle. We're probably going to see a higher interest rates, say, over the next 6 months to 1 year. And some of the leading economists and the ex-finance minister have also suggested that. The other thing is risk. I think the Dow has come out from a period of extremely low volatility. I don't think it fell in more than 11 months. I don't think the intraday volatility was any high. But I think markets are now rearing the head of volatility again, so we'll have to deal with that. Having said that, I remain optimistic on an Indian recovery. It might take a little bit longer. I think it takes some time for all the malaise that has been built up into the system, all the excesses to be wrung out. But the question I ask myself, Neeraj, every single morning is that, are we seeing a bull market top? In which case, if we think it's a bull market top, we need to sell the rallies. Or are we seeing a correction in a bear market? I think on balance, if you ask me to stick my neck out, I say we're seeing a very sharp correction in an ongoing bull market.
Ramesh, if I may just add to, I think, some of the headwinds that you already listed, and that is commodity prices moving up, crude, not just crude, but I think we've seen that in a fairly sharp metals recovery over the last 6 to 8 months, now. Does that not change fundamentally your stance, maybe not on the top with regards to the bull rally, but at least a slowing down of momentum with regards to the bull rally for this calendar year, given that where we stand today, everything now seems to have been fully priced in?
Well, you could say that about some mid caps, but they don't really count. I mean, in terms of the percentage of float to market cap of India, is the large caps count. And if you look at, say, tech companies, pharma companies, OMC companies, they're trading at fairly, reasonable PEs with, actually handsome dividend yields, and companies that have just bought back their shares. So, I would not make that argument that the large cap stocks in India are grossly overvalued. I think because of domestic liquidity, we had a huge run-up in mid-cap stocks, and quite a few analysts have come and warned against keeping on chasing those higher returns. But that's typical of a bull market, that people get complacent and people get carried away, and the multiple keeps expanding. And then there's an occasional reality check that, as we took place on after the budget. In terms of the market being disappointed by the LTCG, yes, it's disappointed. Anytime you tax people some more, they are going to be disappointed with the additional tax out there. And I think we don't like the framework. I think if the government had, say, made an effort to reduce STT, saying we're going to normalize LTCG but reduce STT, the market would perhaps have reacted correctly. Just look at what is the history of tax introduction in India. You introduce the minimum alternative tax at 7.5%. It's above 18% now. You look at the service tax is introduced at 5%, it's 18%. You look at the dividend tax, it's up to 25% from a low single-digit number. So what happens is once the government gets its foot in through the door, it opens it wider and wider and taxes it more and more. So you had a system that you designed, STT, to encourage people to come into the market, to encourage capital flows. And now in one fell swoop, you've discouraged it by introducing LTCG and retaining STT. So the market was a bit disappointed with the fact that the statements coming post-budget also have not been exactly morale boosting for the markets. But overall, can the market live with the 10% as LTCG? I think they can. I just think the government, in terms of economic policy, should align incentives a bit more precisely.
It isn't just, I think, LTCG or the confusion around what this government's tax policy is, or what any government's tax policy has been in the last couple of decades in this country. Given the persistent increase in cess, the persistent return of some of these things that we thought we had said goodbye to, it's also some confusion on what is the broad economic policy. And I ask you this because I think we go into an election year next year. A lot of the government action this year will probably be led by what outcomes they want next year. How convinced are you that we're playing to a plan? And that plan is of a coherent economic policy. For instance, Manish Chokhani was talking to Neeraj on Friday, and he made this impassioned plea for, more aggressive divestment, saying, why are we borrowing so much money to pay interest when we could be selling off assets, at a much faster pace and finding money to radically change infrastructure in this country? Do you think anything this year is going to change for the better in terms of economic policy?
I completely agree with Manish. I heard that interview, Meneka, and I completely agree with him. And I've been also an advocate of a more aggressive PSU privatization plan. But in the pre-budget, in the post-budget confabulations with the disinvestment secretary, I don't think that is the government plan. That's unfortunate. I think they've taken the centerpiece of Air India, and even if that gets through, I'd be very happy. But that's all they're going to do. They're going to privatize some 24 other PSUs, but there's a very small, marginal, loss-making PSUs. As Manish pointed out, that if you have Aramco getting listed in Saudi Arabia on such a small economy with a $2 trillion market cap, I think there's no reason why we can't disinvest so many of our things. And that's really one of the last major reforms that the government should do, because whether to keep an MTNL on the books, keep a BSN on the books, makes increasingly less sense in a world that's already so well connected. So the government might as well ensure that. And the fact that the government has a clear majority, which it may not have, say, if it comes back to power the next term, is more incentive to do that. That would be the right economic decision to do. If he did that, the market would cheer it. And I'm disappointed that, well, the government has made it clear that it's not in favor of privatization. So they are, in that sense, sticking. But I think the economy calls for some bolder steps. You need to raise resources for infrastructure. And that, as Manish pointed out, is really a good way to do it.
No, but Ramesh, just wondering, there was probably a known fact that divestment is going to be that big revenue kicker for the government. Expectations were for about 1 lakh crore even for FY19. Do you think that's a missed opportunity because the equity markets were buoyant, without doing any kind of tinkering, you could have had this 1 lakh odd crores or maybe more coming in from divestment. That seems to be a far cry now. Even the government's target is 80 odd thousand.
Yeah, I agree with you, Neeraj. I mean, one never knows how these things play out. Maybe the market, bottoms out at the end of February and then starts to rally again because corporate earnings will be better. Oil prices may come down, which could, provide a boost to our domestic markets at least. Or FI flows may resume because they're leaving developed markets and coming back to emerging markets. Any number of things can, change the cocktail that we are facing right now. But, what was good economics? Good economics was saying, okay, finally I'm going to bite the bullet in terms of the PSUs. I have MTNL, BSNL, and a whole bunch of other PSUs that make no sense from a strategic point of view in India, for a governance point of view in India, and already because technology has overrun these companies. So I'm going to monetize the assets, sell them, just like the government is doing, say, for the NCLT program, taking these unviable private companies that are deeply in debt and auctioning them. The government needs to do that perhaps with its own assets. It is a very important reform. But, I don't think successive governments have had the, courage in the stomach to go ahead with this. For some reason, it's a politically no-go area.
Okay. Ramesh, the other part is earnings. Now, we just spoke about it. I'm borrowing a leaf out of Menka's earlier question to you as well. While earnings seem to be on the track to revival, there are a couple of things which are starkly different in calendar year 18 versus calendar year 17. One is the commodity price upticks that we've seen, and therefore the hit on the operational picture, as the case may be. Two, in all probability, we'll have a hawkish RBI, if not a dovish RBI. I mean, a dovish RBI is out of the question for sure. We'll probably have a hawkish RBI, if not a stable RBI. What do these two do to the earnings picture for calendar year 18 or FY19, as the case may be?
Yeah, again, Neeraj, I'm not necessarily an expert on the big macroeconomic picture because I tend to look at stocks more on a bottom-up basis. So I'm trying to look at individual companies in that sense. But I think from talking to my friends who understand these things, they tell me two or three things. First, they say that the fiscal deficit, which caused some amount of consternation in this year's budget because it was exceeded, will come in, at the government number next year because they expect fiscal buoyancy. Why do they expect fiscal buoyancy? They think the GST is coming through with some sort of delay, so that will be good. Tax collections, even in the last year, were very buoyant. They were ahead of the budgeted estimates, and because there's a corporate earnings recovery underway, I think even this year they will exceed the targets that have been set in the budget. So the fiscal deficit number will come under control. The RBI may be forced to raise rates marginally because in a world where rates are going up and there could be some inflation, to keep that under control, they will, probably raise interest rates at least marginally in the next 6 months to 1 year time period. So individually, when you look at companies, whether it's cement companies or whether it's, the steel companies, they all are tending to guide towards a more robust year in the current year. And there are then, of course, companies like technology, pharma, that are not exposed necessarily to the commodity price cycle. So maybe you have to make your bets within that area also.
Ramesh, do you believe that the fund flow we've seen come in from retail investors through mutual funds into equity markets over the last 2 years is likely to sustain this year, and notwithstanding cuts like today's, which are temporary? And I think we've seen in the last year or so that retail investors seem to have found the stomach to be able to tide through, some difficult days. But is that momentum something that looks like it will continue? And I think the second part to my question is that typically, since this money is going to a universe of fairly small stocks, right, at the end of the day, how much tougher has it become for these funds to continue offering returns that will keep these investors happy?
Well, that's, Menegas, the million-dollar question. I think the big worry on the Wall Street is that the domestic flow that has been the bulwark of this bull market for the first time in the last 50 years perhaps, may now change because it's no longer that efficient to buy stocks. You're going to be charged 10%, short term is 15%. There's no great difference between short term and long term. So, investors may say, I'll take my chances in fixed income perhaps because it will do better. So, there is a big risk on the market. The bulwark of the market has been domestic savings, that even when foreigners sold, India could absorb it, and there was no issue about that at all. And you kind of spooked that brilliant play we had going for the last 2-3 years or so. So, clearly, I would be worried about domestic flow. I think it's too early to try and tell what is going to happen in this, but obviously now equities is going to compete with a lot of other asset classes for the investor attention. So we may even see a slowdown. In terms of foreign money, I think there is some chance, because of global economic recovery continuing, foreign money that has been largely going to America and to other countries might come back to India. So that would, help us. In the last 2 days, foreigners have actually bought into India, maybe 1,000 crores on each of the last 2 days. So that has helped us. Menika, all these balls are juggling in the air. I don't think, at least I have the right answers to this. But I can only tell you from my long experience in the Indian market that the Indian economy is on a growth track. I mean, these things will happen and will continue to get derailed over time. But there are businesses that are doing well. There are companies that are doing well. And until proven otherwise, I'm going to remain that this is a bull market. Then this is a correction within that bull market. Menika, the second part of your question, could you repeat? I kind of lost my track of thought on that one.
The second part of the question had to do more with the bottom-up approach that you speak of, which is that, where do you see value in this market? And I think I correlated that to the fact that the bulk of the money that's come in has been invested via mutual funds in a fairly small universe of stocks. Maybe there is value to be found outside. Where is that value today? Can you talk us through what you see or find most interesting?
Menika, I think clearly I think the large caps will be re-rated. But when the year began, I think maybe I came on your show or a few other shows, and I said, the quadrant that we are looking at in terms of growth, one would be the quick service restaurant or the QSR space, because I feel that plays into the themes that are most promising about India, from unorganized to organized, women working outside the house, lack of domestic help, AC, Wi-Fi, hygiene, all these things it plays into the quick service restaurant. It's a fairly small area with only a few dozen stocks to actually take a look at. But if you do your pick and choosing, these businesses can compound over long periods of time at 15-20%, because this is very nascent industry in India. I think basically as we move to a more prosperous economy, people will want better hygiene standards, better quality of food, better choices, and a better environment. So that seems like a fairly decent area to look at. I think people have been a bit negative on the real estate sector. I think in terms of valuations, they're very cheap, so they will do well over the next few years as Indians want more affordable housing, as the push for affordable housing increases dramatically. We like the gaming stocks because we realize in Asia, across Asia, whether it's in Japan, Indonesia, Malaysia, Philippines, Singapore, all the governments are opening up and legalizing the gaming industry. I think India is inevitably going to follow suit. There are not many choices and they're fairly expensive, but these businesses can get really expensive over periods of time. So, the gaming industry looks good. And then always the area that I'm most excited about, Menika, is what we call the shift from service-led tech to intellectual property-led tech. I think we've made a lot of money over the years on services-led tech. You go get a contract, do the billing system, do the accounts receivable, cost you 100 rupees, you charge 120, and the arbitrage made the stock market investors very happy. But I think increasingly that business becoming more productive, more commoditized. But there are companies that are developing intellectual property, all right? And companies that have intellectual property by definition will have pricing power and will enjoy fatter margins. And now for the first time, I've seen companies move out from the intellectual property model into from the service model to the intellectual property model. And I think within that tech space, we can find companies, small companies under a few thousand crores, which are providing algorithms, intellectual property. I think that will be a great area to invest for the next 3-4 years. I think you have to have a very sharp eye for those values. But I would encourage investors to look for companies that are, developing intellectual property. I think that's where I find the sweet spot of, my eyes wake up that there could be, huge moves in these companies in the next 3 to 5 years.
Ramesh, that's a much riskier, if I may call it that, riskier area in tech to bet on than what has become the service-led technology area, because there, once you have the skill set, you're just pitching for larger and larger projects. IP-led tech is a hit-and-miss game. So how do you go about identifying the right kind of companies with the right kind of qualifications or attributes to invest in? That's question number one. Question number two is, in previous interviews, you've mentioned airlines as the fourth corner of your quadrangle of investments. Did you intentionally not mention it today, or it's just that you've replaced it with tech as something as more interesting or fascinating to you at this point in time?
Menika, it is harder, I agree with you, but the returns are much superior if you can find these companies. I mean, when you were buying the service companies, people were buying the old economy, but you took a chance on these service companies and they became behemoths in their field. I'm talking Infosys, Wipro, TCS. If you're buying them in the 90s, they were unloved, unnoticed, and people all gravitating towards the old economy, but the pioneers in that made very well. I think there's the next generation of tech companies. The problem with the old companies, Menika, I find, is that while they will do well, they are unlikely to have the glamorous P's of before. So you should be satisfied with the probably, plodding rate of growth rather than some superior rate of growth that we've been used to in the technology company. Some of the younger companies might seem expensive, might seem a bit wishy-washy in terms of operational efficiency, but they're doing very exciting things. And you wake up every morning saying, good, I'm excited about these companies. And I would say companies doing with, say, work with Aadhaar, companies doing work with data, companies doing work with cybersecurity. That's the sweet spot of companies delivering intellectual property. And if you look at what's happened in the West, all these companies, Facebook, Google, Tencent, Alibaba, they're all companies working on intellectual property, algorithms, negative working capital. So it's amazing how the market has shifted to valuing companies with hard assets to now only value companies with some sort of intellectual property. And Uber, a great example of a company with no physical assets, but having a $50 billion valuation. So I think some of these companies are there for India. The second part of the question with the airlines, I'm sorry I missed that. Yes, I am bullish on airline industry. I think the big fear, Menika, everyone has with the airline industry is that with oil prices going down, that will, cap their profits or lead them to losses. But there are a couple of things that have changed within this industry. They have moved from, single pricing, so you pay 5,000 rupees and get everything included, to a la carte pricing. So as you know, when you fly, whether you pay for your baggage, whether you pay for your meal, whether you pay for your seat, everything is now priced separately. So that ensures that anytime oil spikes up, these companies' profitability will not get thoroughly quashed. Plus, they've already introduced fuel surcharges whenever price goes up. And I don't know if whenever I travel right now, there's just an unprecedented boom going on in the Indian travel industry. And because of the reputation that it has, you are not going to have a new entrants come in. So there's going to be a play of 4 or 5 people in the domestic market. So that means they will ultimately have some pricing power. And so I think the long-term prospects for the airline industry, look exceedingly good. And as you know, Menika, the millennials, the generation that is the future of our country, no longer want to buy things. They want to buy experiences. And you want to buy experiences, you have to get there. So I think airlines will, probably do well. And, I'm fairly bullish on that sector.
Okay, interesting. Ramesh, maybe one final question from my end, and that would be on whether you are doing anything in this whole data boom, because there are enough and more stories coming in, whether they are data enablers, whether they are optic fiber companies enabling data to reach you, so on and so forth, whether they are equipment manufacturers. I think a tech company falls within that bucket of providing antivirus solutions as well. So multiple ways to play this data stroke mobile phone enabled data theme. Are you nibbling? Are you biting into this pocket?
Yes, I am. As you mentioned, I had positions in a cybersecurity firm. I have companies that invest in routers that help data move. I have investment in companies that actually provide access to them from a customer point of view. So the lots of nuggets that you can pick out. Some large caps, some small caps. But as everyone has been saying consistently, that data is the new oil. So and I believe that. So you clearly want to look at those kind of businesses because they're also bulletproof. I think increasingly, I mean, anywhere you go without Wi-Fi, the thing doesn't work. I mean, you need Wi-Fi. You need to be connected 24/7. That's the mantra of the millennial generation, if you will. And I think if you look at what happened in patent usages, what stunned me, Neeraj, is that in the US, for the first time out of 50 years, people are delaying getting their driver's license because they don't want to drive. They just want to be connected. You know, they order food in, they connect with their friends on social media. They're delaying getting their driver's license. That's how much far the movement towards data has gone. So they're staying home and staying connected through data. You know, I'm not sure that will happen in India, but, you know, I think data consumption is, going to boom, and you have to find different ways to place it. And you have to think about all the ramifications, whether in terms of cybersecurity, whether it's in terms of social media, whether in terms of router networks that you have. So I think there'll be a lot of opportunities for savvy investors in that area.
You know, Ramesh, I'm sure that the bulk of your portfolio is just finding these great companies that offer you value and that you want to hold on to for a long period of time. There must be some part of it that is a slightly more medium-term oriented portfolio. At the start of a year like this, when you know that the momentum in markets isn't going to be anywhere as good as last year's momentum, when you know prices are necessarily not going to climb as much, if at all, versus last year, do you change your investment strategy at all? Do you look at the markets with different eyes and say, here's where I'll put my money because it's safer, as opposed to what I would have done last year?
You know, Menika, these are all questions that we ponder with every day. If I felt in my bones that this market had topped out and that we were going to enter a bear market, I would be trying to raise cash. I mean, I don't raise a lot of cash, but 20-30% of my portfolio, I would try and raise cash. Having already told you that I don't feel in my bones that we're not in a bear market type of situation, but more in a bull market correction. The philosophy that I've learned over many years, and this has come through trial and error, is to find great businesses. That's the first thing we want to do. We want to find good managements running great businesses, and then we are happy to hold them for long periods of time. I mean, just like, businesses don't go bad because the market goes down. We're ready to hold them through even an economic downturn. So I think my entry criteria is much more stronger for a business. I want to be convinced that there's a great opportunity, there's a management who has an ability to meet that opportunity, and I feel that that opportunity should exist no matter what the external environment happens. I mean, even if oil price goes up, even if interest rate goes up, these businesses should be able to perform. So we tend to look at in terms of life cycles of businesses, not necessarily in terms of markets. So I mean, it may not be the best thing, but we often hold through a lot of very difficult periods in the market. I mean, for example, when Brexit happened, when Mr. Rajan left, when the Donald Trump election happened, markets are down 500, 800,000 points in a single day.
All right, fair enough, Ramesh.
So, we retain those businesses, and over time, that has been a winning strategy.
Okay, let's hope it's the winning strategy this time around as well. I'm sure bulls are hoping for that. But Ramesh, so good of you to spare this time and join us today. It's an interesting day of trade. Let's see what the week throws out. Thanks so much for joining in today and giving us your thoughts.
Sure, Neeraj. Sure, Menika.